All right, so now let's talk about what constitutes adequate proof of a deduction. As I said, the burden of proof is on the taxpayer to prove that you are entitled to a deduction. So now how do you do that? Of course, obviously, we think in terms of documents. The first thing that comes to mind is you got to have a piece of paper. And that's generally what the IRS is looking for, a piece of paper. All right, but there's actually 6 different ways to prove a deduction. And I want to talk about all of these things generally. All right, first of all, you got your canceled checks, of course. Proof that you paid utility expenses for your business. You're going to have canceled checks. You've got cash receipts or invoices. Cash receipts show well, let's back up to a check, for example. Checks are very helpful because, of course, you got the amount and the date right there on the check. You've got the payee on the check, and you got the nature of the expense. Hopefully the nature of the expense is on the check as well. This is the problem that a lot of people have with their checks, however, is they don't write enough details on the check to allow a third party to look at it and see at a glance what this particular payment was for. So often canceled checks have to be supplemented with other information. All right, and an invoice may be the other information. So if you get an invoice from the XYZ business, and then you write a check to the XYZ business in the amount of that invoice, and you can tie the two together, then you've got rock solid proof of your deduction. Of course, a cash receipt can do that as well. You can pay invoices with cash, just like you can write a check, and if you can tie that together with a receipt to the invoice, then you're good. Year-end statements are very, very helpful. I like year-end statements as the best way to prove a deduction, the single best way to prove a deduction. And the reason is because the year-end statements are provided by a third party, and third parties never lie. Of course, we all know that. The IRS is particularly impressed with third-party statements because it's not a statement by the taxpayer, it's a statement by some third party, even though it's absolutely, from a legal standpoint, is absolutely 100% hearsay. It doesn't matter. The IRS accepts it at face value and accepts it as the gospel truth. And so a year-end statement would be the perfect example of the year-end statement is the statement you get from your mortgage company that tells you exactly how much mortgage interest you paid over the course of the year. You get a year-end statement from the county telling you how much real estate taxes you paid. But you can get year-end statements from anybody, and it might be that you have to do some digging to get these things, particularly if it's after the fact. But if a client can go out and get statements from providers and so forth, suppliers, people that are vendors for the business or whatever the issue may be. Of course, we're talking about year-end statements when we're talking about charitable contributions as well. You get a year-end statement from the church or the charitable organization you gave money to that tells you exactly how much was paid, the year in question, who paid it. So year-end statements are outstanding as far as being a comprehensive list of the elements that you have to prove to support that particular deduction. Logs and journals are also very, very important for proving certain business expenses. For example, if you claimed business miles, business use of your vehicle, you got to have a business log to support that, or a mileage log to support that. The mileage log has got to establish that the travel was for specific business purposes. And so logs and journals are very, very helpful. If you've got listed property, for example, a cell phone, and with listed property like a cell phone, you've got to establish that phone is used 100% for business if you're going to write the whole thing off. If you aren't writing the whole thing off and you're saying, well, it's 50% business, 50% personal, how do you prove the business use? Well, you're supposed to have a log or a journal to do that. And so most taxpayers don't have that, but that's something you need to consider in the context of perhaps a reconstruction. And that's the fifth area. Taxpayers lose records all the time. Just because you've lost your records doesn't mean you lost the deduction, all right? You can reconstruct the records. We're going to talk about that. And then testimony of the taxpayer themselves is proof of a deduction, and the tax court regularly accepts taxpayer testimony as proof of a particular deduction in the absence of a full package of documentation to support it. And we're going to talk about what that testimony looks like as well. The irony of testimony, however, is that the IRS, at least at the audit level, this is not true at the appeals level, and it's absolutely not true at the tax court level, but at the audit level, these auditors will routinely reject the statement of taxpayers regarding a specific expenditure, and they'll say, well, we just can't take your word for it. We have to have proof of this. We have to have verification of this. But testimony is an absolutely viable, legitimate way of proving expenses, of proving any fact. All right. Just take the murder trial, for example. You got the witness sitting on the witness stand in the murder trial that says, I saw the defendant shoot the victim. Well, the defense attorney doesn't go up there on cross-examination and say, do you have a receipt to prove that? Well, no, there's no receipt to prove that. This is something I witnessed with my own eyes. I experienced it with my own senses. I saw it with my eyes. I heard it with my ears. All right, that is what the nature of testimony is all about, is providing inside information, specific information on what was experienced with the personal experience with one of the senses of the body, the eyes, the ears, and so on. And so this is completely allowable, and we're going to talk about that in just a second here. Actually, we're going to talk about that as we move on with part 2 of our audit defense strategies. We'll talk about that in the next section. So obviously, the proof of a deduction is best used in combinations of these things. It's rare that you would have just one item to support all these things. It's best to have a combination package of information. So now let's move on to negotiating specific points with tax auditors. When we're negotiating specific points, I just want to give you some tips here. First of all, you always want to focus on agreements when you're dealing with these people, not disagreements. And by that I mean, if you've got, let's say there's 4 or 5 or 6 things on your audit list, issues that you've been dealing with. You want to start these 6 items or 5 or 6 items, whatever is in question here, are going to fall into one or two categories. They're going to be major issues, and they're going to be smaller, less significant issues. The major issues are what I call litigation points, and what I mean by that is these are things that you do not want to give up on at any expense. If the IRS says, for example, that your client had $50,000 worth of income they didn't report on their tax return, that's not something you want to readily concede. Likewise, if the IRS disallows all of your travel expenses, and there's $15,000, $20,000 worth of travel expenses on the tax return, you don't want to just cave in on that. All right, but then we got smaller issues, and the smaller issues are oftentimes bargaining chips. And by a smaller issue, they say, well, they've disallowed $50,000, they've disallowed $20,000 worth of travel expenses, but they've also disallowed $200 worth of office supplies. All right, so those are obviously the smaller things that you can afford to give up without affecting the long-term financial security of your client. So what I do is I try to work on the smaller things first, and I get the IRS to concede on the smaller things so that you don't have to give those things up as you go through. And so we work from smaller to larger issues and focus on agreements in the course of the process, the facts that you can agree on during the course of the process to get the IRS to give up on these issues so you don't have to trade them away. All right, so let's talk about negotiating the deduction, not the tax, because this is important also. I have people tell me all the time when they're going through a tax audit, let's say the IRS comes back with an audit that says they owe $10,000, and the taxpayer says, well, 10 grand, that's a lot of money. How about if we just give them 5? Will they take 5? All right, well, what you're doing in that situation is you're negotiating the tax. When you're going through a tax audit, tax auditors will not negotiate the tax. Their job is not to negotiate the tax. Their job is to determine what the correct tax liability is. And then it's a matter for collections to negotiate the tax if it ever gets that far. So if you want to take your tax liability and cut it from 10 grand to 5 grand, you can't offer the IRS 5 grand. What you got to do is look at the specific deductions that were disallowed. Let's get back to our travel expense deduction of 20 grand. IRS disallows the travel expense of $20,000, and you say, well, look, you've disallowed the entire expense, but we've provided evidence that establishes this and this and this. We've provided documents, and yeah, we're missing some records, but we provided an explanation, and we provided testimony, and we'll talk about what that looks like. But, we've established that we've got some basis for the deduction. We should be allowed half of the deduction. And so when you're negotiating the deduction, not the tax, the examiner has the authority to give you half of the deduction or 3/4 of the deduction or whatever it may be. And then that has the corresponding effect of reducing the tax liability on behalf of your client. The last thing I want to discuss here in this particular element is don't argue based on nuisance value. All right, do not argue with the IRS based on the nuisance value of the case. It's never going to get you anywhere. Where the IRS says, well, okay, we think the number's 10 grand, and you're all out of negotiating strategies. You can't go to them and say, look, guys, you're going to spend $6,000 or $7,000 trying to collect this tax anyway because you got to do this and you got to do this. How about we just settle it for the 4 grand or 5? That's nuisance value. They're never going to settle based on nuisance value. If the IRS believes you owe them $50 or your client owes them $50, they'll take the case to the United States Supreme Court over $50. All right, because if they believe they're legally entitled to the money, they're not going to give up based on nuisance value. What you have to do is negotiate in terms of hazards of litigation. All right, so getting back to our $50,000 or $20,000 travel expense example. All right, IRS disallows the entire travel expense, but we're arguing to them that they should have allowed this expense or this portion of it or that portion of it. And now we're going to present to them the discussion that says, look, guys, if we take this to court, there's better than a 50-50 chance we're going to win it. And there's better than a 50-50 chance we're going to win it because of this reason and this reason and this reason. And you lay those out. And now, if you can establish that there's approximately a 50-50 chance of winning the case, the IRS will concede the deduction based on 50%. So it's hazards of litigation that we got to focus on, not the nuisance value. All right, so let's move on here now, and let's talk about extending the assessment statute of limitations. And then we're going to, I want to deal with this because this is very important. As I said earlier, the IRS often asks taxpayers to extend the ASED date, assessment statute expiration date, to give them an opportunity to get the case wrapped up before they have to close it out. All right, first you need to understand that the taxpayer has no legal obligation to sign a waiver. No legal obligation to sign a waiver. All right, the IRS claims that you're going to lose your appeal rights if you don't sign it, but that's never true. This is a tactic they use to deceive and mislead people into signing these things that they don't have to sign and in some cases shouldn't sign. It's never true that you lose your appeal rights. What is true is that the character of the appeals process changes. It ends up going down a different track, and I'm going to show you what that track is right now. We go to the next slide. What happens if you sign the waiver and give the IRS more time to complete the audit? Your case is then forwarded to the Office of Appeals prior to the issuance of a notice of deficiency. At the Office of Appeals, they will consider your case and they will look at the facts and circumstances of your case before they issue a notice of deficiency. So you have that opportunity for an appeals conference before the notice of deficiency is signed. So what happens if you don't sign it? The case goes down a different track. And it's different slightly in that once the IRS has its back against the wall on the assessment statute, they will issue the notice of deficiency right away to protect the statute so it doesn't run out. All right, so now you've got the notice of deficiency in hand. You didn't sign the waiver, so they issued the notice of deficiency. And so now you've got the notice of deficiency, and what you have to do is file a tax court petition. You now have 90 days from the date of the notice of deficiency, the date of mailing actually, of the notice of deficiency in which to get that petition filed with the tax court. We'll talk about that in just a minute. But now here's what happens. You've got a docketed tax court case now. The case gets sent back to the appeals office for full and complete consideration at the appeals level. So you do not lose your appeal rights. You end up in tax court first, then the case goes back to appeal, and it is advantageous in a lot of ways to be in tax court versus not being in tax court because it puts a lot more pressure on. So now the question is, do you sign or not sign? What should the taxpayer do if he's requested? Sign or not? I've got a checklist here of things to look at. Consider signing consider signing the waiver if the auditor you're dealing with is reasonable. If this is a reasonable person and you're making progress and you think you can get the thing resolved, then there's no reason not to sign it. You can keep working with that auditor, get your case resolved. All right, if you think your case is going to settle short of a notice of deficiency, so you never end up in tax court in the first place, that would be one reason to sign it as well. Maybe you got multiple years that are under examination and you want to maintain continuity of the audit. If you've got, tax years 14, 15, and 16, for example, and 14 is about to run out, then you might sign the waiver on 14, but not on 15 and 16 to keep these things moving forward, especially if you're dealing with a reasonable auditor. Now, you never, this is worth repeating now, you never lose your appeal rights by signing this thing, and you don't lose appeal rights by not signing it. So just because you sign it doesn't mean you've given anything away to the IRS in terms of issues or appeals rights. So keep that in mind. The other thing you can do is negotiate the length of the waiver. Just because the IRS asks you to give them an extra year doesn't mean you have to give them an extra year. And as a matter of fact, I rarely sign a waiver that gives them a year. What I will often do is say, listen, I'll give you 6 months on the waiver, and let's work real hard to get this thing resolved. My client doesn't want this hanging over his head. So let's just make a commitment here to get this thing resolved, and I'll give you 6 months. And if we can't do it in 6 months, then we'll reconsider. You can also negotiate the terms of the waiver. All right, not just the length, but the terms. You might say, well, listen, we've got 3 of the 4 issues in this case resolved, so let's get those done. Let's get those wrapped up, and we'll give you an issue on, I'll give you a waiver on this one issue. The IRS has 2 versions of the 872. It's an 872 is the one version, which is a specific date on which the waiver expires. The other one is the 872A, which is a open-ended waiver. I don't recommend signing the open-ended waiver, but if you do sign an open-ended waiver, you can always terminate it by submitting Form 872T for Tango to the IRS. That will terminate the waiver. So you're not stuck just because you signed an open-ended waiver. Keep that in mind. All right, now you would consider not signing the waiver if the assessment statute is very close to expiration and you just want to put the heat on the IRS to get the thing done. Because there's a chance they might miss the statute, and I would never give them an extension if I thought there was a chance that they would just simply miss the statute of limitations. If you're dealing with an unreasonable auditor, don't sign the waiver, because that's a great way to get the case out of the hands of an unreasonable auditor. Let them issue their notice of deficiency, file your tax court petition, and get the case into the appeals office. And if you want to pressure the IRS to settle the case and stop lollygagging around, you're going to not sign the waiver at that point in time. So you keep that in mind as well. Now, the last point I want to make, and then we're going to wrap up for this session, and that is at any point along the way here, you need to keep in mind that you've got the opportunity to have a conference with a manager. All right, the conference managers managers conferences are always available. They're available anytime there's an impasse on any issue. So you don't have to wait for the audit to be concluded in order to have a conference with a manager. So I would bring, particularly if you're dealing with an unreasonable agent who is uncooperative in terms of demands, who's uncooperative in terms of timing, uncooperative in terms of visits, any of those things, I'd get the manager involved. And that would, that'll help you keep the agent under control. So, all right, friends, that concludes my presentation here entitled Negotiating with Revenue Agents Part 1, Audit Defense Strategies, and then we'll move on to Part 2 next time. So thanks a lot.
All right, thank you so much for joining. As you can see on your screen, we've got some additional resources, ways to reach out to Dan and see his websites as well, also some things that we have with Canopy. We do hope you'll join us for Part 2, as Dan's going to go more in depth on some of these things and cover, again, those strategies and other things. So thank you so much for joining, and we'll look forward to seeing you on a future webinar.